So in this video, I want to talk about why I find covered calls to be very powerful. I want to give you an example with the stock Dell. So Dell is a stock that I bought in July. And first of all, let's look at since July. So since July and up to today. So right now, Dell is trading at 51.63. Since July, Dell was trading at around 51. So almost the same thing. So from July to today, Dell would still be worth the same thing. It has gone up a bit since, but then dropped all the way down to 45 and then went up again to 55 and back down to 49. So it's always trading in the last, maybe since July. So what is this, 6-7 months? In the last 7 months, it's been trading at inside this range approximately. But let's say I was a long-time investor in Dell. So I'm going to buy and hold it forever. So let's say I would have bought it at 51. 7 months later, it's still trading at 51. So I would have been pretty disappointed seeing that I've been holding the stock for 7 months and my money is still worth the same thing. And not only that, but at some point I had decent capital appreciation because at some point Dell was trading at 57 and then all of a sudden all that capital appreciation is gone. So I would have been pissed if that happened to me. I would have regretted not selling here, did not confirm my capital appreciation. Not only that, it actually went even lower, and right now we're back at square one. So the beauty of covered calls is while you're holding a stock, if you own at least 100 shares of a stock, any multiple of 100, so if it's 100, 200, 300 shares and so on, what you could do is while you're holding the stock that you like so much, you can sell a call option against it. And when you sell a call option against it, which is called writing covered calls, because you own 100 shares of the stock and you're selling one contract of a call option against your stock, you're collecting a premium. Right away, that money comes into your trading account. But of course, against that premium, there's a risk. The risk is based on the strike price that you choose to sell your call option at, you risk losing your shares at that strike price at expiration. Right now, if I buy Dell at 51 and I sell a call option at a 52.5 strike, and there's 30 days with an expiration of 30 days, come expiration, if Dell is trading above 52.5, I'm forced to sell my shares at 52.5, but at least I made a premium, the premium that I collected by selling the call option, but I also made the difference between 52.5 and 51.65. So I made a capital appreciation and I collected a premium. But if Dell does not trade above my strike price of 52.5, I keep my shares and I keep the premium. So I want to go through some trades I made on Dell since July. So I exported the activities on Dell from my Questrade account. So July 1st, as you can see here, I bought 100 shares of Dell at a price of 51.3 about, and I immediately sold a call option at a 50 strike with an expiration of July 19. So basically I'm going in selling a call option that's lower than my purchase price. So basically I want my shares to get taken away at 50. All I want is the difference. I want to keep that premium, the premium of 262 minus 137, so it's about $130. I want to take that premium between July 1st and July 19. I just care about that premium, so it's a return of 2.3% in 19 days. That's what I was going for. I didn't plan to buy and hold Dell. And then July 19, so at expiration, I ended up closing the trade. So Dell though moved up to 56.94. Obviously, when I bought Dell July 1st, I don't know where Dell is going, and I don't want to guess where Dell is going, but it ended up going to 56.9. So if I had just bought the shares without selling a call option, I would have been better off, of course, but I didn't know that. Regardless, I confirmed the profit from the beginning this way. So I ended up selling the shares for much higher and buying back that call option that I sold for $262. I ended up buying it back for $704. But because the shares were trading for more, it compensates. So the combined trade gave me a profit of $114 after commissions. So it's still $114 divided by my initial investment of $5,100 in 19 days. So it's a conservative trade, but I don't have to rely on mystery. It's almost a confirm. I'd rather take my profit up front with a good chance of keeping it than to buy and hold and wait to see what happens, being at the mercy of the market. And then August 2nd, I went back in. So August 2nd, as you can see here, I bought Dell at 52.85 and I sold a call option this time at a 52.5 strike, collecting $190 with an August 16 expiration. Now, August 19, you can see that Dell was trading below 52.5. In fact, it was trading at 49. So because it was trading below 52.5, this call option expired worthless. So I ended up keeping all of it. I didn't have to buy it back or anything. I still own my shares. They're worth a little bit less, but I've collected that premium. I'm going to go ahead and sell another call option at the same strike price of 52.5 because I don't want to lose my shares anything below my cost price of 52.85. So that's why I'm going for the same strike, 52.5, 52.5. So first time collected 190, second time 154. And then September 20th, these two transactions here on September 20th, you could see that I bought back the call option that I sold and sold another one. Now let's go see where Dell was trading at September 20th. September 20th, Dell was trading at 52.94. So it was trading above my strike price. And instead of losing my shares at 52.5, I decided to just roll the call option forward. So what I did is I bought it back, but I sold the next one. I sold the next one to the next expiration, October 18. So the September 20th expiration call option didn't expire. I bought it back and then I sold the next one at the same strike, 52.5, at an October 18 expiration, collecting $180. So 190 the first time, 154, 180 the third time. And then October 21st, let's see where Dell was trading at October 21st. October 21st, Dell was trading at $50. So below my strike of 52.5. So what's going to happen is my call option that I sold at 52.5 will expire worthless, and I still own my shares, keep my shares, and I'm going to sell another call option at a 52.5 strike again. But this time, because the stock dropped, it's far from that 52.5 strike. The premiums I can collect is going to be less. So this time I only collected $69, but it's still a decent amount. And this is per month. All this is per month: 190, 154, 181, 69 on an initial investment of $5,000. And then October 29th, let's see where Dell was trading at October 29th. So October 29th, Dell went up, trading at 53.25. So definitely it's above my strike. So if it's above my strike, I have to buy back the call option if I want to keep my shares. So I ended up buying back the call option at 125, but right away, same day, same transaction even, I sold the next expiration. So I bought back the November 15 expiration and I sold the December 20th expiration at the same strike. So the combined trade gave me a credit of 143. So you can see the first time 190. Second time 154, third time 180, fourth time $69, fifth time combined a net credit of 143. So that's on October 29th with an expiration of December 20th. Now December 18th, so 2 days before expiration of my last covered call trade, which expires December 20th. Let's see what Dell was trading at on December 18. So December 18, Dell was trading at $50 again. So Dell was trading below my strike of 52.5. So what ended up happening is I bought back the option just to be able to roll the call option forward. I didn't want to wait till expiration and that it expires worthless because I was afraid that Dell would drop even more. So I simply bought back the call option that I sold. The December 20th expiration, I bought it back here for very little, and then I sold the next month's call option for $67. So the net credit here is about $63. This time with the same strike, but the next month's expiration, which is January 17th. Okay, so this covers this here, December 18 trade. I bought it back and sold it again, collecting a smaller premium because the stock was trading at $50. Now, January 9th, let's see where Dell was trading at January 9th. We're going to move the stock, we're going to move the chart a bit. So January 9th, Dell is trading at 49.62. So once again, below my strike of 52.5. So instead of waiting, I ended up buying it back and selling the next month's option, which is February 21st. So that gave me a net credit of $73 this time, and I've got an expiration of February 21st. Now today is February 21st. I'm recording this video February 21st. I ended up doing the exact same thing. Dell was trading slightly below 52.5. Let me log into my Questrade account and I'll show you how much I collected this time. So today I collected $225 by rolling the call option from February 21st expiration to March 20th expiration. So let's say $220 after fees, after commissions. So this I'm writing in because it doesn't appear in the report because I made the trade today, and this report is only between January 2019 to February 20th, 2020. So I just added it in manually, but today is what I collected on Dell by rolling the call option from the February 21st expiration to the March 20th expiration, but always at the same strike of 52.5, collecting $220. So now here's the two scenarios I want to compare. If I had bought Dell back in July like I did and did nothing, did absolutely nothing, and just held on to Dell, today I would have no profit. Today I would be basically at break even, because the stock is trading at the same price I would have bought it at July 7th, which is 7-8 months ago. Who knows, maybe I would have sold it at 57. Definitely that in that case I would have been up, but I don't know that that's going to happen. This could have never happened. Could have actually dropped straight to 49. I really don't know what would have happened. But if I had just held, if my plan was to hold it forever, right now, currently after 8 months of holding Dell, I'd be up 0. But by selling call options, I still own Dell right now. But if I take into consideration all the premiums I collected by selling call options against my position, against my 100 shares of Dell, so this trade here, profit of $114. So I'm not going to take this into consideration because this line here is basically my investment. It's my 100 shares that I bought of Dell. I just want to take into consideration the premiums collected. So the premiums collected will be a total of, and I'm going to include the premiums that I sold today. So I collected a total of $1,204 in premiums by selling call options against Dell for the past 7-8 months. So instead of being up 0% by selling call options, I ended up being up 1204 divided by my investment of 5285, right? Because that's how much I put in. That's how much I put into the stock, 5285. And the premiums that I actually collected and ended up keeping, these premiums are mine. I don't have to give them back. My only consequence of collecting this premium is that if at expiration the stock is trading above 52.5, above this strike, I lose my shares at 52.5, but I'm okay with that because I paid 52.85. And in exchange, I got a lot of premiums. I got $1,200 worth. So that's a 22% return just by collecting premiums in the past 7 months, as opposed to doing nothing, holding on to Dell and waiting to see what happens. So this is a great example of why covered calls are amazing. Now, it doesn't always turn out this way. Sometimes you buy a stock and the stock drops 20-30%. In that case, selling call options is better than nothing, but you're still stuck holding a stock that's down 20-30%. And then sometimes when a stock drops 20-30%, you're unable to find premiums at the strike price that you bought the stock at. So you're forced to sell call options at a lower strike, but then you risk losing your shares at a lower price, lower than your initial purchase price. So this is just an example of when covered calls can be powerful and why I love them. But going forward, I don't plan on selling covered calls on individual stocks. I just want to sell covered calls on ETFs like SPY or the Qs, because they represent the general market, and the general market always goes up over time. So I'll never be in a position with an ETF where I'm worried if my stock is going to come back up above my purchase price. Eventually, it will come back above my purchase price, even if I bought the ETF too high. For example, right now, I'm in that position with the Qs. I bought it at 233.88, and right now the Qs is trading at 229.72. But I collected a lot of premiums on this right now. My strike is 232, so I'm prepared to sell my shares at 232, but in return, I collected $1.20, I collected $1.25 or $120, $125 from the Qs, and I collected initially another $100. So basically I collected about $345 from this position here. So although I'm down on the underlying stock, I'm down about $400, but I collected about $345 in premiums. And my expiration is March 6th. So by March 6th, if the Qs is trading above 232, then I get my money back, plus all the premiums that I already collected are mine. If the Qs is trading below 232 or near it, well then I keep my shares and I can continue selling call options against it. Same exact thing I'm doing with Dell. So what I like about covered calls is that I don't have to predict where the market is going. I'm basically generating that income that I want from my stock or from my position by selling that call option, regardless whether the stock goes up or down. So it works great when the stock is trading within a certain range, but it's terrible if a stock just goes up like crazy or goes down like crazy, because then if it goes up like crazy, you're missing out on decent capital appreciation. And if it goes down like crazy, then you're holding a stock that down 20-30% and you're unable to sell call options at a safe strike price. All right, so if you have any questions, leave them in the comment section below. Like always, if you can open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.